In 1970, the United Kingdom discovered substantial oil reserves beneath the North Sea, a discovery that promised to revolutionise the nation's economy. In the early days, North Sea oil production brought in significant revenue for the United Kingdom, peaking at around 4.5 million barrels per day in the late 1990s. Today, that has dropped to 1.26 million barrels per day, a 50-year low. The North Sea oil discovery initially prompted a popular vision of UK prosperity and energy independence, heralding what most believed would be a new era of British economic prominence. However, half a century later, the UK faces a starkly different reality. The nation now grapples with energy insecurity and unfulfilled potential. This raises critical questions about the decisions made in the intervening years. How did a resource that seemed poised to bolster the UK's economic standing become, instead, a subject of scrutiny and disappointment? What series of choices and policies contributed to this unexpected outcome? The United Kingdom of the 1960s and 70s faced severe economic challenges, including soaring inflation, rising unemployment, and an eroding industrial base. In this context, the 1969 discovery of oil in the North Sea appeared to be a serendipitous gift to the struggling nation. Initial projections estimated up to 25 billion barrels of oil, raising hopes for energy independence and economic prosperity for generations to come. Before we move forward, make sure you like this video and subscribe to our channel for more weekly geopolitical content. The UK government swiftly established a licensing system to attract international oil companies, and by 1975, large-scale production had commenced. However, the UK's approach to managing this newfound wealth differed significantly from that of Norway, its North Sea neighbour. While Norway established a sovereign wealth fund for future generations, the UK focused on immediate gains. This short-sighted approach had profound consequences. Instead of investing in infrastructure, education, or economic diversification, successive UK governments used oil revenues to fund tax cuts and sharply increased public spending. In fact, in 1973 to 74, government spending as a share of GDP was 40.3%, before rising to 44.7% in 1975, and increasing yet again to 46.5% in 1976. The UK enacted these policies to address the harsh economic climate of the 1970s, including high inflation, unemployment, and deep public discontent. Utilising oil money to foot the bill, the popular British political strategy of this era emphasised stopping the societal hemorrhaging rather than strategising towards a long-term financial vision, which is what the decade so desperately needed. But then again, hindsight is 2020. Much of the spending went towards stabilising the economy amid widespread strikes and economic stagnation, exemplified by the Winter of Discontent in 1978. Economic projections consistently overestimated future oil prices and production levels, leading to overly optimistic budgeting. It got so dire for Britain in the 1970s that some historians refer to it as the gloomiest period since the Second World War. As oil production increased throughout the 1980s and 1990s, the UK economy became increasingly dependent on oil revenues, constituting up to 8% of the country's overall GDP by the late 1990s. This reliance set the stage for a dramatic economic shift when production inevitably began to decline. The peak of UK oil production occurred in 1999 with an output of approximately 4.5 million barrels per day. From this zenith, production began a steep decline, falling by an average of 7% per year in the following decade. The consequences of prioritising quick profits over sustainable economic planning were about to become glaringly apparent, highlighting the risks of resource-dependent economic strategies. While oil flowed freely from the North Sea, another vital resource was silently ebbing away. The UK's manufacturing sector once the backbone of its economy, was entering a period of unprecedented decline. This decline was driven by globalization, which saw manufacturing jobs outsourced to countries with cheaper labour, such as China and India. This paradoxical situation exemplified the resource curse phenomenon, where countries rich in natural resources often experience less economic growth and worse development outcomes than those with fewer resources. The UK government's management of its oil wealth presents a stark case study in missed opportunities. Instead of investing in long-term development projects, the government primarily used oil revenues to fund current spending. This short-term focus contributed to a lack of sustainable economic growth and set the stage for future economic challenges. The impact on British manufacturing was particularly severe, largely due to the Dutch disease effect. This economic phenomenon occurs when an influx of resource revenues leads to a stronger currency, making a country's other exports less competitive. In the UK's case, the strengthening pound, bolstered by oil revenues, made British manufactured goods more expensive on the global market, further accelerating the sector's decline. The government's approach to oil revenue management has been widely criticised for not addressing long-term economic challenges. By failing to invest sufficiently in alternative energy sources, education and skills development, the UK increased its future energy dependency and left its workforce ill-prepared for subsequent economic shifts. These decisions had far-reaching consequences for the UK's economic performance in the post-oil boom era. As North Sea oil production began its inevitable decline, these missed opportunities and squandered resources became increasingly apparent. The UK found itself transitioning from a net exporter to a net importer of oil, a shift that would have profound implications for its economy and energy security in the years to come. This change heralded substantial economic and geopolitical challenges for the nation. The decline in the North Sea oil production, which had begun in 1999, led to persistent trade deficits and weakened the pound sterling status as a petrocurrency. Consequently, British exports became less competitive in the international market, further straining the already struggling manufacturing sector. The repercussions of this shift have been particularly evident in the energy sector. The government has acknowledged that oil and gas prices are now largely determined by volatile global energy markets, exposing consumers to price fluctuations and generally higher costs. This situation has raised concerns about long-term energy security, especially as domestic production continues to decline sharply. Paradoxically, despite still producing oil in the North Sea, approximately 80% of this output is exported rather than used domestically. This has left the UK heavily dependent on energy imports, creating a precarious situation for the country's energy security. The North Sea oil and gas industry now faces an uncertain future, with small operators struggling under a taxing regime that has made investment challenging. As the UK grapples with these immediate challenges, the long-term consequences of resource management decisions are becoming increasingly apparent. The country now finds itself at a crossroads, forced to re-evaluate its national resource management strategies in light of its diminished oil production and increased energy insecurity. The UK's failure to establish a sovereign wealth fund, in contrast to Norway's successful model, has had profound implication for its economic landscape. While Norway's government pension fund Global, valued at over $1.4 trillion, ensures long-term benefits from its petroleum sector, the UK's approach has left it vulnerable to economic instability and energy insecurity. Expert calculations reveal that the UK could have accumulated an estimated $324 billion in additional fiscal revenues between 2002 and 2015, had it established a similar fund. This substantial figure represents a critical missed opportunity for long-term economic security and development. The absence of such a fund has contributed to the UK's current economic challenges, with public sector net debt reaching approximately £2.4 trillion, representing around 100% of GDP. The consequences of this decision extend beyond fiscal issues. The UK's increasing reliance on energy imports, with around 80% of North Sea oil production being exported rather than used domestically, has exposed the nation to global market fluctuations. This has been acutely felt in the months and years since Russia's invasion of Ukraine, when UK oil prices jumped from $90 per barrel in January 2022 to $127 per barrel in March 2022. A well-managed sovereign wealth fund could have provided a buffer against such volatility, ensuring greater energy security and economic stability. Economist Juan Carlos Bo argues that the UK squandered a crucial opportunity to address significant social and infrastructural issues through the creation of a sovereign wealth fund. The potential benefits of such a fund could have included solutions to pressing social problems, infrastructural improvements, and provisions for future generations of British citizens, particularly in helping the nation pivot to become a leader in the green energy revolution. As the UK faces an uncertain economic future, the absence of a sovereign wealth fund serves as a harsh reminder of the importance of long-term resource management. The contrast between the UK's current economic indicators and what they could have been if British leaders had the wherewithal to set up funds similar to those of Norway's underscores the need for a re-evaluation of short-term political strategies. The UK's mismanagement of North Sea oil wealth exemplifies the consequences of prioritising short-term gains over long-term investment in resource management. The absence of a sovereign wealth fund, akin to Norway's, has left the UK susceptible to economic volatility and energy insecurity. This approach has significantly impacted the country's fiscal revenues and overall economic stability. As the UK currently faces profound energy and economic challenges, political debates now centre on how best to transition from fossil fuels to clean energy projects. This shift reflects a growing awareness of the need for sustainable energy management and economic planning. But perhaps this realisation has come too late for the nation. The UK's experience with North Sea oil underscores the critical role of long-term resource management in shaping a nation's economic trajectory. As countries worldwide confront the challenges of finite natural resources and sustainable development, the UK's North Sea oil debacle offers valuable insights. The imperative for balanced approaches that encompass both effective management of existing resources alongside leadership and vision in articulating a transition to sustainable energy solutions is now more evident than ever before.